and Jim Farrell and Shirley Ogden that are all on the committee, and we have sponsors. I'll go a little slower through the sponsors. 5Q, Wade Hughes, Jason Myers from Barnes and Thorngood, David Ramsey and Heidi Henderson from Engineered Tax Services, the fabulous Mr. Tom Rogers from McGriff, Siebels and Williams, Greg Blankenship from BB&T, and of course Baker Tilly, Paul Greilick, and Chris Johnson. So we appreciate that. So we're going to have 6 polling questions that pop up on your screen throughout the event. You have to answer at least 5 of them if you want CPE credit. Don't have to answer them right. You just have to show that you're breathing. So please pick an answer. If you're one of the people that has administrative rights, please do not pick the end polling at the bottom of the screen because we'll have to stick it back up again. You can just move it out of your way. So today, Paul Greilick will be the moderator. If you have questions, please send him your questions using the chat functionality. At the end of the event, we'll have some open Q&A, and you can raise your hand and we'll be able to unmute you if you want to ask one interactively, but you can also submit questions throughout the program by sending them to Paul. So to be eligible for CPE credits, you must answer 5 of the 6 polling questions and have a total viewing time of 75 minutes. That viewing time starts once Paul starts talking. Participants will receive a CPE notification through the email when the credits are available, typically 7 to 10 business days. We are unable to grant CPE credit in cases where technical difficulties preclude eligibility. CPE program sponsorship guidelines prohibit us from issuing credit to the blah, 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 not verified technology, so forth and so on. In accordance with the standards of the National Registry of CPE credit will be granted based upon a 50-minute hour. So now I hand off to the fabulous Mr. Paul Greilick with Baker Tilly, who will be introducing the panel and moderating. Thank you so much, Paul.
Appreciate it, everyone. Thanks for being here and taking time out of your day. Try to bring something really valuable to you today. We want to just take a look at the current status of sort of the real estate market across the nation, and look at some asset classes that may have some challenges to them. Try to consider how you're looking at them. We have a fantastic panel discussion for you with Don Braun, who's with the Hall Group president, and also Adam Miller with CFO with Matthews Southwest. These guys have deep experience in a variety of asset classes, from hotel, multifamily, and single family, golf courses, industrial as well. We have Brent Mayer with Baker Tilly. He leads our valuation group that also does a lot of M&A activity and pre-work, and fantastic pedigrees with both Mike and Brent. Big Four. Mike leads our Chicago practice, CRE practice, where he works with a lot of large developers doing fair value audits, works with mergers and acquisitions, large complex transactions, and consulting. As I mentioned, Brett Mayer leading our valuation group. His backgrounds with Houlihan Lokey and KPMG before that, and works with a number of our strategic clients that are on the advisory side and strategic side. So we want to bring you sort of a good rounded picture of what's going on in the industry around us and some of these asset classes, how valuation experts are looking at it, how buyers and sellers are looking at things, and then sort of bring into it the accounting and reporting component of it for those of you where that's important, because there's some nuance here this time around. We're going to focus on real estate today, but really it's any PP&E, I think, is going to come under a lot more scrutiny from auditors, where you've got long-lived assets that are that could very well have triggering events Most real estate is probably going to have a trigger event, though some classes may not. And then how to look at it from whether it's a long-term or short-term period view. The hold period, as you'll see today, is going to be an important component on it. Looking at the cash flow analysis and going through how some of the impairment rules work to round it out. So with that said, maybe we can just jump right in and with the panel and have some discussion on some of these topics. Again, if you guys have questions, I'll try to be monitoring the chat or the Q&A rooms. Just let us know what those are. We want to make this an interactive dialogue between us. And so please feel free to raise your hand or ask a question in the chat. We'll probably open it up toward the end after we get through the bulk of the presentation, just to let people ask questions. We'll unmute and you can ask questions. But with that said, I thought I would kind of kick this off with the guys that really are in the trenches, not just the accountants and the advisors, but Don Braun, as I mentioned, is with Hall Group's president. And these guys have been around a long time. You know them if you're in this Dallas market or Texas market, certainly nationally as well. You know, Don has worked with Hall a good part of his career and seen a lot. You know, Don, I guess I would just put it to you. I mean, how is this different from other cycles that you've seen, and where do you see it go from here?
There you go. Thanks, Paul. You're kind to say I've been with Hall a bit of time. So I have worked with Craig Hall for a good portion of my career. Been fortunate to work with him and the rest of the team there. So a good place to jump off. My career spans now 5, let's call them cyclical turns in the real estate world, in the real estate economy. And, as I think back, and I've been asked that question, as I've been thinking back about those, each one is unique and different in certain respects. But most of them, if you think back, are always driven by the catalyst is typically capital driven. And that is too much capital chasing too little a demand sector. And however that manifests itself, it manifests itself in different ways in prior periods, but it's always been capital driven. And this is obviously not capital driven, right? The real estate markets, from my perspective, across almost all product types, let's say, were in a pretty good equilibrium prior to this downturn. So I think that is, really quite unique. And, really what we have is sort of a real jolt to the demand side of it, because of the pandemic. So from that standpoint, I kind of see this as it's not a straight line up or a straight line down, but I do see it in the grand scheme of things in a shorter term view coming out of it. And again, different product types will have different, different exits out of this at different rates. But I do see it overall as being a shorter period of recovery.
That's great. That's great news. Adam Miller with Matthews Southwest. Many of you probably have heard of the high-speed rail that's being developed between Dallas and Austin. Matthews Southwest, Jack Matthews is the lead sponsor of that project. Dallas High School development, all the South Lamar hotels and development, they've been a big part of that. They've come farther north. They've come north too to help develop around the Tribute, single-family homes and golf courses. So broad experience. Adam, how would you respond similarly to that question? How do you see the current events playing out and the impact? You guys are in hospitality down there in South Lamar, multifamily as well. what are some of the short and long-term impacts you guys are anticipating?
Yeah, thanks, Paul. So with our South Side on Lamar assets, so we span the gamut. We have operating companies where we have Gillies, which is an entertainment venue that most of the business is done through large corporate events or other functions that are usually tied to the Dallas Convention Center, since we're right next to that. When the convention's having events, a lot of times whoever's in there will host an event in some form or fashion at Gillies. So obviously with the downturn, we've seen a big dip from an operation perspective. Same with Alamo Drafthouse, the movie theater we have down there. They've been closed from a multitude of reasons. They have the pandemic, and I think I just read something. It was either this morning or yesterday where AMC, one of the large movie houses, said, even if the vaccine works, the movie houses still aren't releasing anything new until the April timeframe, and so you're going to have a lag there also. So I think a lot of it's going to be dependent on the industries that you're represented. Multifamily so far has fared fairly well. Our single family lots up at the Tribute have fared extremely well during this period. We had a little slowdown, but then now we've already seen the uptick already coming back. The 2 golf courses we own out at the Tribute, we had some good golf chatter in our breakout room, and the rounds there are, substantially higher. It's almost like every day in the week is a weekend day for golf rounds. And so what I'm actually not looking forward to, but I'm interested in seeing is, hopefully the vaccines start coming out, everybody able to start attaining those, and then the numbers start going down and some sort of normalcy comes back. And I'm interested to see when that happens, how that impacts our golf rounds. Will we see a downtick in the golf rounds? And so maybe our golf might actually go decrease when things improve. And I think, a lot of our businesses and a lot of the ones in the Metroplex, especially in the urban core, are heavily dependent on business travelers. And so how are companies going to start opening their doors back up to business travel? Are they going to, or is that going to extend maybe a year, 2 years out, even 2.5 years, 3 years by, we've been doing these Zoom meetings, team meetings and everything now for coming up on, 9-10 months. And you can be pretty productive on them. So is the required travel, is it going to be necessary? So, it's going to be interesting. I think some of them might last a little bit longer, what I would say the downturn this time around because of the pandemic, but largely I think because of the business travelers. I think that's really going to have a huge impact on, some of the hospitality industries, the entertainment industries, restaurants, obviously in your urban cores, I think are going to get impacted also. So that's where I see some of it. I see it's going to be varying depending on your industries, and then, how people react to your office space. Our office is going to, when it comes time for lease renewals, are they going to be shrinking the amount of required space, or is it going to be one of those things, and I think we sometimes have we get forgetful fairly easily. And, if your lease doesn't renew for 4 years out, are you going to really think back to the times of the pandemic to when most people are working from home, or if things came back to normal? Are you really going to think about shrinking your space at that time? So it's going to be an interesting dynamic when we come out of this and how it impacts all the various industries. And, across our portfolio, we have a healthy chunk of each of the individual industries. So we'll have a good assessment of how things are reacting. It's just going to be a matter of, what is going to happen. I wish I had a crystal ball for it, but unfortunately, I don't think anybody does at this point.
Right. Yeah. It's a tough call. Brent Mayer leads our valuation group, advisory group on the real estate side. What's your view out there? Is it more of a short-term impact, and how would you define that? If it is, Baker Tilly just, I think I saw the email this morning, pretty well keeping us out of the office until, was it April, I think?
Oh, wow.
Was the message. So we're still working remotely. We can still meet with clients and do things out of the office, but just trying to be careful. But looking across some of the other asset classes, Brett, what are you seeing?
Well, the recovery period is certainly going to vary by not only the asset class, which both Adam and Don kind of touched on, but also your geography, right? someone invested in Manhattan is going to have a lot different recovery period than someone invested in in our breakout room we had someone from Grand Forks, North Dakota, and the North Dakota economy is doing a lot better than our friends in New York. So I think it's going to depend not only on your asset class but also your geography. And I think as far as lodging, I think group travel, business travel is going to have a large impact on the lodging industry, of course. One thing I think we might see in the lodging industry is once there is a vaccine and people have reached the threshold of confidence and are willing to travel, I think we're going to see a spike in the full service and resort type property. And I look forward to that. I know most of us want to get out and travel. We're either sick of our families or we're sick of our basements and wherever we're working from. So that'll be interesting.
Yeah, I think hopefully it'll be short term. Hopefully we'll be able to get back to some of those things that we love and sort of kickstart things again. I hope Don's right. I hope things get back going again. But I suppose in the interim, there's been some concessions along the way. Would that be fair, Don, from a rent concession perspective and some of your assets?
Well, it's interesting. It depends. Everything and every answer basically should start with "it depends," right? To anything we're talking about, maybe not just to real estate, but to everybody who's on this call as to their individual business. It depends. What we found. We have a brand new hotel we opened downtown, the Hall Arts Hotel. From a sector standpoint, it's a 4.5, 5-star luxury kind of business traveler. During the week was the segment it was targeting, and then kind of leisure, arts district patrons and the like on the weekends. So why I start with that is this. Initially, there's this knee-jerk reaction again, and think we're in this kind of COVID pandemic, 8 or 9 months. So if I think back a lot to what I thought about in March and April and May, and my reactions then, and how that's evolved and changed. It feels like a year or more, but it's really an incredibly compressed period. We've come through a lot, and when I think back to that period, our knee-jerk reaction was to lower the rate at the Hall Arts Hotel. And really, at that point, what we found was in lowering the rate there, that it didn't really, there was no demand, right? So we were just pulling on a string at that point. And so we were really just kind of encouraging maybe not the kind of people we wanted there. And so at the end of the day, we increased the rate. So there's really, within a range, there's really not that much different in the rate we were seeking than what we're charging. Now, there's a giant rate difference in the amount of people staying there, but in terms of, the impact. So on that hotel, not so much. On other things, particularly office, clearly it changed overnight from a landlord market to a tenant market. And, I think, we are consistent with most landlords where we're competing is, on free rent and on tenant improvement concessions. So, from that standpoint, there have been concessions. So I could go through each one, but, that immediately comes to mind for me.
Mike, what are some of your clients saying to you about this topic? Regardless of asset class, concessions, or forecast.
Yeah, a lot of concessions in all asset classes. Multifamily is certainly the strongest, but the office space. I was on the phone with a client earlier today who owns a lot of office space in the River North area in downtown Chicago, which is a really, really nice area, and owns restaurants, owns office, and his comment to me was every day gets worse. It isn't getting any better. Here in Chicago, in the whole country, right? We're looking at another potential lockdown, and you know, he was, as I was talking to him, he was looking out his window, which is literally in a beautiful place in downtown Chicago where everyone is walking around at 12 o'clock going to lunch. And he literally said he cannot see one person. There was not one person on the road, on the streets. So it's, a lot of concessions. We're working with clients, every day on the accounting side because, there are a lot of clients going to landlords and asking for rent concessions. I've heard clients tell me, landlords tell me that it's tough for them to even understand sometimes whether the tenants really need a concession or not. But they're all asking for them because that's the thing to do right now. So, really challenging. So office is really challenging, and obviously, as we heard about, earlier, the hospitality space. But, it seems like I love the comments about a quick recovery. I do believe in that. I'm just a little bit, I'm starting to trying to figure out when's that going to start. When have we, around the country, we keep getting more and more cases, and in a lot of the country, winter's coming up, right? So I think we will have a quick recovery. The one thing about people in this country is we get back at it. We get back at it pretty quickly. To Brent's earlier point, I know my family's ready to get on a plane and go somewhere warm. So I think we'll get there quicker. It's just a matter of when's it going to start.
Yeah, I think that's a fair statement. And just when is there how fast can we sort of deal with the pandemic? So I think that'll be important.
Paul, I'll add just one thing real quick on the concessions. Don did a good job talking office, hospitality, and so did Mike. From a retail perspective, we have quite a few retail tenants down in and around the South Side area. And, there we're working with the tenants as best as we can. We're assessing their situation. Obviously, if you're a restaurant, you can't be open. We completely understand it. You do need assistance. Some of our office tenants that we have in and around the Metroplex, again, we work with them and assess their situation. Are they, and we start asking for financials and asking for some others so we can assess, is it a need, or is it hey, this would be nice. Everybody's probably asking, let's see what we can get sort of deal. And so we've been working with the tenants, but another thing that we've been taking into consideration, and I imagine most are, is, some of these properties we have debt on. So we have lenders. So we have obligations as the landlord to our lenders. And thankfully, our lenders have been very gracious with us and working with us. And we work on game plans for, and like Don said, everything should start with depend, right? It depends on the asset type and, what revenues are coming in, what can we support? Can we move it to an IO for, 9 months or till we can weather the storm? Do we need to put up an interest reserve? Like, what are our options? So it really is just working in detail with our lenders also. And then that has provided us flexibility to maybe offer some more concessions that maybe we might not have been able to if our lenders weren't willing to work with us.
Have you guys looked at some alternative pricing strategies like percentage rents and things like that, where that's not already in place? Revenue based on revenue, things like that.
We have, us personally, we generally tend not to include the percentage rent into our normal calculations, but it is something that we are in discussions with, at least during this time period. It might not be something we move into long term, although some tenants might ask that in the future, when lease renewals come up. But right now, that is, really with us, nothing is off the table. We really try to work with our tenants and, what is your need? How can we assist you? And then also let them understand what our needs and requirements are. And so it's really just been open dialogue. And I find the more open you are with your tenants and the more open your tenants are to you, you could probably strike a better deal that's going to last long term than just a couple months and you're knocking on each other's doors again in 2-3 months to figure out what the next step is going to be.
So
I have a couple thoughts. I have a couple thoughts just on what both Adam said and what Mike said. Starting with what Mike said earlier about the office market. And again, I'll just go back to maybe my refrain of it depends. Well, in the office market particularly, I think there's it's very difficult to talk about these sectors in a holistic manner. Urban is certainly suffering over suburban. And I think that, particularly maybe in Chicago, mass transit and all the things that, go into that. our operation is a suburban operation in, a vibrant part of, North Dallas, Frisco. And, what we see is, we're still not seeing, large amounts of people coming back to work, but, in terms of the tenancy, we're not really seeing any impact to collections. We did see a tremendous amount of requests for rent abatements or rent forbearance in April. And I think, sort of the messaging maybe at that point was maybe there's a little bit of a rent holiday or a payment holiday, and everybody was sort of jumping on saying, well, shoot, I need to get in on this too. And, for us, we immediately, try to quash that as a theme, right? There is no rent holiday because, as Adam said, we have lenders and, we have constituents as well. And so we really have very little, if any, immaterial collection. I'm not going to talk about demand side for the moment, but I'll just go off there. And I do think, there are fundamental changes to come. And I think in part, Paul, you mentioned percentage rent for retail, particularly on the restaurant side. We're going to see a giant amount of restaurant retail particularly, that's going to be available. And I wouldn't be surprised as a theme going forward, for a period of time at a minimum, several years, that we do see a lot of more percentage rent deals done over the next few years than, the high base rents, with CAM on it.
Right. So maybe that's a good segue to talk about the deal space. What are you guys seeing? There's got to be some operators out there that are hurting, some troubled sectors, maybe some opportunities. Obviously, you guys are sponsors, but you're also investors. What are you hearing from your investors out there? And what are you guys seeing out in the market right now? Is everyone still just kind of hunkering down and waiting for better times, or are you actually seeing some deal flow? I would pose that to any of them. Whoever wants to jump on that one.
I'll take a little stab first. We're seeing deals come through our pipeline still, but a lot of them at this point, with the unknowns, the price reductions that would probably be required for us to jump in at this stage isn't quite aligning with what you're seeing in the market due to the pandemic. And so from our perspective, we're holding tight. Obviously we are looking at things, considering things. We're looking at, always looking at land opportunities in and around the Metroplex. We also have operations in Canada. We have a hospitality arm that has focused in the past on convention center hotels, which, as you can imagine, has taken a big decrease in the last 9 months. But at the same time, there was some tax legislation, and I'm not going to get the code right, but there was some tax legislation passed for certain municipalities that they qualify. You could attach hotels or convention centers, and you get tax benefits for the surrounding areas too. And so we're working with a few municipalities in the Metroplex to start considering options to take advantage of that. And we could be shovels in the ground on a few smaller style convention center hotels in and around the Metroplex municipalities probably in the next year. And so, there are opportunities out there. It's just, the sector, I haven't seen the large buy opportunity yet from distressed opportunities. Don might have a little more insight on that one, but I haven't seen it yet, but I wouldn't be surprised come first quarter, if things are still where they are, end of first quarter, that there could be a little bit more buying opportunities at that stage.
Yeah, I'll comment as well, unless Brett or Mike want to do it as well. I don't want to make sure to give them an opportunity, but first off, this is classically kind of early cycle, cyclical changes where bid ask, what happens first off is there's just a disconnect on the bid ask, right? The sellers on the ask side and the buyers on the bid, just don't, are wide apart. So that's nothing really different than what, what I've seen in multiple cycles before. In part, what I think I'm a pretty, it's kind of amazing, but not, just interesting, is the rapid speed at which, giants amount of capital was circled for distressed opportunities. And I think, I'm trying to think back to 2008, 2009. I just didn't have the same sense that, in almost light speed, hundreds of billions of dollars get circled, by these giant, by Blackstone, Apollo, the usual names, and everyone else. I mean, even, companies like ourselves, would have started aggregating capital for the same purpose and different sort of execution. So I find both of those interesting. We've been participating in some things, that are distressed opportunities. And, frankly, there's been a pretty good bid on, what we think that, what most things that are out there, there's been a pretty decent bid. I think in terms of, mostly because of the amount of capital that's been out there. And in part of that kind of makes me optimistic that the market clears pretty quickly. In terms of, when I say early on, I said, a relatively rapid recovery, what I'm really talking about is from a historical perspective and not saying, Q1 2021. But, if you think back to, the 1980s, that was a 10-year recovery coming out of there from, or 7 anyway. If you think about, 2008 and 2009, it was a, 4 or 5 year recovery. I think in this market, it clears quicker and we are back in a more stabilized fashion for the most part. Look, there's going to be laggards because the product type is no longer meeting the demands in a changing society. But, on a whole, I feel comfortable saying that.
Yeah, that's good. Brent, what are you seeing in the M&A activity world you live in?
Yeah, no. Well, I just wrote down, Don said Q1 2021 recovery. So I
underlined the word not.
No pressure.
Not. That's
no,
not
I
my
think he hit it right on. There was a lot of capital and he started off the conversation exactly right. This is not a capital driven issue. And coming into the pandemic and the downturn, right, balance sheets by and large were in pretty good shape. And so I think that there's a lot of capital chasing opportunities, right, and very high yields, and they're just not getting through to those opportunities. So you have to get a little bit creative on how you get those through and actually get to transact. So I think if I kind of picture the tide going out, everyone thought the tide was going to go way out and there's going to be a lot of people exposed. But I don't think the tide's going to go out as far as we initially thought. And I think largely because there's a lot of capital that's going to, basically hold the values for us.
Yeah, that's, the only thing I'll add, Paul, which is, I agree with Don completely. I don't think there's a week that goes by where I don't get a phone call from either client who's looking to, start a fund, raise another fund, or a prospect is looking to start a fund in anticipation of the recovery. So, I have multiple clients who typically do one-off JV deals. And now all of a sudden they're like, we want to raise the capital. There's going to be huge opportunity. Now's the time to do it. I think every other day I'm reviewing, new fund docs from startup funds who are looking to raise capital to enter the market as recovery occurs. The other interesting thing I'll just throw out, we talked a lot about hotels. We talked a lot about retail, talked a lot about office. I have many clients across the country, not only in Chicago, who are multifamily, student housing, and industrial. And those companies, right, they're out there pounding their chest saying, invest with us, look at us, we're resilient. We're the one area where this hasn't impacted us at all. Our collections are higher than they've ever been. Student housing was a very interesting one, right? I mean, I would have thought student housing was having some issues, and for the various student housing clients I talked to, it's the opposite. They're killing it. Kids are back in school, whether they're going to school or not, they're back because they wanted to be back, or their parents forced them to go back because they couldn't take them anymore. And the parents are paying the student housing bill. So it's been interesting to see. I've had clients come to me, or people I have relationships come to me and say, student housing was an interesting asset class. Not many people understood it, and now they're getting calls daily from new investors. People want to put capital into those deals because they see how well it did during time, a time like this. So just a lot of interesting dynamics going on in all asset classes. So I just wanted to add that.
Paul, you're on mute.
Yeah, there you go. Thank you.
Can you hear me now?
Yeah.
We can. Yeah.
So Don and Adam, you guys are both, I mean, sponsors and investors in these deals. Lenders also with Hall Structured Finance. How are financial institutions sort of responding in terms of, it's all trickles downhill, right? If you're not able to pay your rent, you're not able to pay your debt. How are some of the debt covenant compliance and how are people reacting with and working with some of the lenders? Have they been pretty pretty flexible in working with you? And obviously we've got people on all sides of the table here, but whoever wants to jump in on that one, just how are banks and lenders responding?
Well, I think it's so when you say banks and lenders, so I think of those maybe as there's two classes. If you're talking about, financial institutions, banks particularly, or lenders, like ourselves, private lenders, private lenders may act a bit differently just because we don't have regulatory considerations. So we can, we can operate without that constraint or thought behind us. I will say this: the banks, and we're very active from a capital market standpoint as a borrower, across, all type of capital market areas, and it is interesting in the banks side when in talking to banks, coming into the pandemic, you call a bank and you say, "Gee, I want 90 days of debt forbearance." And the banks basically just said, "Okay, here, I'll send you this form document, you sign it, and we're on our way." Which was all, which was sort of everybody's kind of my thought about, how different things have changed or how things are evolving. And that was sort of, call it maybe sort of the great unknown period or panic period. I don't know how you want to reference it, but, we were sort of all in this thick fog and nobody knew which way was, up, which way was down, which way was, east, west, north, south. Clearly, my discussions with banks today, particularly as I talk to them about buying notes or doing other things, is that the banks are going to be less forgiving and less pliable, if you will, going forward. Is where I think things go from a trend standpoint.
Yeah, no, I don't disagree with that. Generally we're fairly low levered at Matthews. But the leverage we do have, we've been working with our banks. And like Don said, at the very beginning, it was, hey, can we work on a 94-day forbearance? Yeah, sure. No problem. Let's get it done. And then, now when we're talking to them, we have to, really show a lot more, which is fine. But they've still generally been able to work with us is the best thing that we've had so far. But we've had to post some significant interest reserves. I think a lot of it is due. We don't want to push our loan into the bad loan side on the bank side, right? And so the banks are saying, what can they do within the regulations to keep this loan as a performing loan, and showing that it is pandemic driven, it is impacted by that. Well, if they can put up 100% interest reserve for 9 months, I'll give you IO for 9 months and just pull on that over these next 9 months. And so it has changed since the beginning of the pandemic to where we are now. And for us, I don't know what the next step will be. We have, a fairly nice interest only period. But if things continue on past that, it will be interesting to see how the banks do change at that point in time. And I think a lot of it will be based on what the regulators allow them. If you're dealing with true banks, obviously private lenders are a little different beast, but from a true bank side, yes.
How are your equity partners just as patient?
They have been. I think on our side, thankfully, we haven't had to make any capital calls. Thankfully, we do have, polling question just came up.
Oh, sorry. Go ahead.
Thankfully, we have some patient investors, and that's been helpful. And, very early on, we've established healthy reserves. We generally like to keep close to a year of true operating expense and reserves for our various assets. And that has proven out to be a godsend here when we now are going into month 10 of the pandemic, and especially on the retail side where we have tenants who can't be open. And so therefore they aren't generating any revenue. The PPP loan early on helped, and that has allowed some of them to make rent payments, but that lasted for about 3-4 months. And I know a lot of them are waiting anxiously to see, what comes in the next round, whenever that may be. And so we're monitoring that too. And that comes into our equation on concessions also, right? Like if the tenant we know is working, we'll help them work on getting a PPP loan, but then have some stipulations in there to where a certain percent will be geared towards rent and allow us to collect some rent. So that's generally what we're seeing currently.
Yeah, well, that's good. Okay. All right, good stuff. We have a question.
Oh, you asked, Paul, you did
Someone
ask
here?
about covenants.
Mm-hmm.
And thankfully, the lenders have also been giving us debt service coverage ratios and all the other, financial covenants. They've been giving us relief on that side also, which has been great, because a lot of those, they would trigger default pretty much immediately if they didn't give us relief on that also and just gave us payment relief.
Yeah, Paul, I'll comment on, I think you also mentioned about, I think you asked Adam about capital from investors, capital calls and the like. I'll say that, for a private lender, we have loaned to, entrepreneurial borrowers, not necessarily institutional, overly institutional folks. And so, when the pandemic, or, when we underwrite it, we typically underwrite right to the property, because we're not looking to the sponsor, for, a tremendous amount of, thinking that they're going to carry the project, right? The project needs to carry itself. And the projects, clearly have suffered and had some difficulty. And while we've worked with, a lot of our borrowers in reducing some portion of the debt service, not a complete forbearance, but in some reduction, I have been, and actually this, I've been really incredibly, pleased and surprised in some respects of the amount of capital that, borrowers have been able to access through their investors or otherwise, to support the properties, assuming that, there's sort of a working together kind of arrangement or, relationship.
Yeah, we have a question from someone in the group participant, and I'll try to summarize it. But basically, it's about debt loads on real estate and some of these forbearance negotiations. Basically, it's asking, how these lenders are reacting if this goes out for an extended period of time. So I don't know if time frames have been discussed in those deliberations, but obviously extended period of time, that sounds like a long time.
Well, I think, look, I think if you have a hotel and it doesn't have any NOI and you can't pay any debt service, it's not going to be very long before the lender's not going to be able to, manage that, right? They're going to have to do something. You're going to sell the note to somebody who's going to be, a private party and, probably act a bit differently. And so I don't see banks being moderate in what they do for an extended period of time. I think, I think given the market today and the amount of capital out there, I think that, they may not themselves want to be the person taking actions, but they'll sell the loans to the extent they can.
Right. So would it be your thought that if they don't start seeing some cash flow by mid 2021, that some of that's going to start happening? Or
yeah, I predict that. I predict that's going to happen. That's part of, sort of the opportunistic play out there that, there's a lot of capital out there. There's not that many deals, but I think while the period of distress and the period of opportunity may be on a relative basis short, it's still coming. It's not past us. It's actually coming.
Yeah,
I agree. And I think that's that end of second quarter, beginning of third quarter is when you'll start seeing it really start getting active out there from that front of, like you said, like banks selling the note to others who will act on it. It might, like Don said, it might not be the bank itself, but somebody will. And I think that time period, if things do not recover And if there's not possibly significant government support, I think it will be tough. And I think that end of second quarter, beginning of third quarter will be an interesting one to follow.
Yeah, we'll be following that for sure. So I wanted to segue a little bit over to Brent. There's a lot of different ways you can look at where this goes. How do valuation experts look into their crystal balls and make these calls? How long will this go? How are you going to even measure cash flows, since we probably have a triggering event here, and we're going to need to do a cash flow analysis, and if that indicates a level of impairment because it's less than the carrying value, we're going to have to go to fair value. And yet, how do we even begin to look at appraisals and valuations in this environment? People are heading into year end. If you're a fair value fund, or you need to measure for impairment, that seems like that's going to be a challenging exercise.
Yeah, absolutely. And, I would encourage everyone, if you are thinking of an impairment, I would encourage you to at least start that process, have those conversations now, so you can kind of prepare the file and documentation. The first thing we look at, and you can't do this holistically across the board, but the one thing is the demand drivers and the end users and how that space is affected, short term with the pandemic, and then long term, and then what's that recovery period, if any. On the retail side, there was a great divide, and that just got accelerated because of the pandemic. The industrial enjoyed a lift because of that acceleration. On the lodging side, it's probably more temporary than long term, although I think we'll probably see a little bit of a divide between some of the group and business travel properties in certain locations. So that'll be interesting. So as you're digging in, you really have to dig into the users and how you can underwrite it. As far as the capital markets, cap rates, it's hard to say because there haven't been a lot of trades that we can point to on the cap rate side. And so our view is cap rates have probably gone up, over the next few months to 12 to 18 months, I guess. But in the long term, over your hold period of 5-10 years, they're probably going to normalize back to what they have been historically. So really, it's just trying to bridge the gap of the next 6, 12, 18 to 3 years, depending on your recovery period.
Mike, you have a lot of large developers and fair value accounting clients on the audit side. Coming up with this kind of cash flow, or just a cash flow model at all, seems like it's going to be really challenging. What kinds of scenarios are you anticipating?
Yeah, I mean, so I am an audit partner, which I hate to admit, but so I do ultimately sign off on, both fair value audits and historical cost gap, financial statements. So, on the fair value side, if you have a fund, which I'm sure many do, that has fair value reporting, investment company reporting, those assets get marked to fair value at the end of the year, and then ultimately the auditor signing off on that, right? And then what I do at Baker Tilly is I get Brent and his team involved. To Brent's point, in those valuations, cap rates are being used, discount rates are being used, revenue growth rates are being used, expense growth rates are being used. There's a lot of subjective information that's going into the ultimate valuation, and traditionally valuation professionals look to recent transactions to support a lot of those assumptions. Well, there aren't many now. It's not that easy anymore. So we have to get creative. I think, I'll tell you, we're starting to review already companies' fair value. In a lot of cases, depending on asset class, we've asked for 930 valuations because we're trying to review and test a lot of those assumptions now. simply because at the end of the year, we all know we're all very busy. So the earlier we can get in front of that, we're going to be asking, your auditors are going to be asking you more questions this year than they ever have. It's just a fact. So the quicker we can get out in front of this and start having initial conversations and bringing all parties onto the phone to talk about this information, the easier it's going to be come February and March. On the historical gap side, same thing, right? I remember, last year, 2 years ago, 3 years ago, it was pretty easy for clients to assert to me that there haven't been any indicators of impairment. Occupancy's up, NOI's up, we continue, revenue's up, no indicators, let's move on. Well, this year, that's going to be a lot tougher to support in a lot of cases. There are indicators in a lot of cases. So now we have to go to step two. Step two is this, undiscounted cash flows. But again, what does that undiscounted cash flow analysis look like? What are the lease up assumptions that companies are including in there? What are the revenue growth rates, cap rates, et cetera? That information is going to be challenged by auditors more so this year than it's ever been. So the quicker we can get out in front of this, the better it's going to be. And then, step three, if you feel undiscounted, the hold period is very critical, right? If you hold the asset, the gap accounting literature is pretty lenient in this area. They say your undiscounted cash flow analysis can stretch out over the useful life of that asset. What is that? Is debt coming due in 3 years? If it is, are your auditors going to be okay with you extending that cash flow period beyond those 3 years? It's definitely going to be a discussion point. So the hold period, I'm sorry, I said useful life, it's the hold period of that asset. How long do you anticipate holding that asset? Are you able to hold that asset for the period of time that your undiscounted cash flow analysis supports recoverability? A lot of questions are going to come up. It's going to be challenged, like I said, more so this year than ever. And then obviously, if you fail that undiscounted test, then you're at fair value. What is the fair value? Is it less than carrying value? Do we need to report an impairment charge? So, without getting too technical, all of those assumptions are critical. But again, there's no reason why some of that stuff can't be talked about now, why auditors can't start looking at some of that information now, and really start, putting together and challenging some of that information now. So that would be my biggest piece of advice as an auditor is, if your auditors haven't asked you about it yet, they should have. So if they haven't, I'd start thinking through it and start building your case to present to them. Because this is something we all know, come March 1st, there's a lot of filing requirements that are due, and waiting is just going to make it very painful.
Yeah.
And one other thing, just along the lines of the hold period, your hold period has to be consistent with your internal planning and external communication. So if you've disclosed that you've got a property or a portfolio you're looking to divest, that will impact your hold period. So that's got to be considered as well.
That's a great point.
How about just some of the uncertainties around these cash flows? It just seems like that's going to be, you're making decisions and avoid in some cases, because you just don't know when that hotel is going to come back. Retail, some of these more troubled classes. What do you do? Mike, have you had any of your clients ask you about going to the income tax basis of accounting?
I have not, and I would strongly discourage them from doing that. But, the other interesting thing, and the reason why I laugh is just because I have many clients over the years who have gone to income tax basis of accounting, and then a transaction is on a transaction pops up where they're looking to do something with the asset, and GAAP financial statements are asked for, and then we have to go back and put together GAAP basis financial statements for and doing that from inception is not the easiest thing in the world to do. So, I'm a big, I love fair value. I think fair value is a great answer. The investors want to see fair value. That's what they care about. So if you can get to investment company, that's the way to go in the real estate world. Second alternative is obviously historical GAAP, cost GAAP with depreciation, which we all know is a little bit odd in the real estate market. But the other thing, or in the real estate industry, other interesting to think about too is, again, what some clients have net worth covenants. What would an impairment charge do to maybe a debt covenant? A lot of times that isn't thought of until after the fact. And again, being the auditor, being an audit partner, I shouldn't be saying this, but you need to drive the conversations. Don't let the auditors. You know your assets. You know what markets you're in. You know your assets. You know your cash flows. You know your lease ups. You do this much better than we as auditors do. So the quicker you can drive the conversation, the better it's going to be. When I start asking questions and I'm not getting answers and the client's not responding to me, what happens, right? My skepticism goes up. So drive the conversations, get that information to your auditors, review the guidance, lay out your answer, and you're going to have much, much better success, ultimately getting them to where you want to be. They have a responsibility, we all do, but I think you get my point. When you're driving those conversations, they go much smoother and you get to the answer you want more often than not. Hopefully this recording will be deleted. No, I'm just kidding.
No, Mike, you're singing what I've been preaching to my finance and accounting teams. And it's really not, it's as much the answer you want, but it also is, the fact is we do know our assets better than our auditors, and we should be driving that conversation, and we should be, be thoughtful about it. But you're singing my song right there.
Yep.
And really, they're just, Mike's team and the auditors, they're really just looking for a story, right? And the documentation. And if you just put that together for them so they can digest it, document it, and tell the story, right? It's just, you got to tell the story to support the conclusion, really.
Right.
And then Paul, I'll go just a little bit into the appraisals, not too much, but a little insight. So we have one of our funds gets audited, it's fair value, and every year we get around 95% of the assets appraised. Our appraisals just came in, I think, earlier this week, and I did a quick look, and what was interesting was our operating assets. So our assets that have like movie theaters, Gillies in there, retail, a hotel, the operating assets decreased in value from about 10 to 18% from last year. Our land holdings in and around that same area stayed flat, like no decrease whatsoever. So from an operating perspective, depending on where you're located, I wouldn't be surprised if you see that 10 to 20% drop. For our hotel, I can tell you what was interesting from the assumptions underlying it is really they reset our occupancy. Is ultimately what happened. The ADR, to like what Don spoke earlier on about their new hotel, is they found, you drop your ADR, okay, but you might be attracting different people. You put it back up, and you're still going to have the same outcome as your hotel's not going to be as occupied. It doesn't matter what your ADR is. So we didn't see a huge drop in the ADR in our appraisals. It was all led in occupancy. And year one occupancy was a level that, to be honest, we have not seen since day one of that hotel operating. But under current situations, we haven't got to that level yet where we are today into the pandemic. And so it's kind of a balance. And so that's what I noticed from a hotel perspective, is it really reset your occupancy a good 5, 6, 7 years, almost to when you first started opening your hotel is where it dropped down to. And then it ratcheted up a little quicker. But that was the biggest thing that I noticed when I was looking at it. Cap rates you did see, and Brett, you noticed this also, is cap rates did go up a little bit in a couple of them, but not all of them. And so again, it depended on the asset type. But that's where I saw a lot of the biggest thing. The revenue growth, expense growth didn't change a whole lot, but it was really that occupancy. And what I would say, even if you have a building that's fully rented, if it's retail, they factored in, high vacancy, which largely was related to probably free rent expectations. They probably expected free rent for, a good 6-7 months in 2021, and then it would slowly come back in the later years. And so again, it all came down to the underlying assumptions. And how you can support them is going to be interesting to see, especially if you don't rely on a third party professional to do it.
It might be a good year to get a professional involved if you've done your evaluations internally, help you make that case. Although lots of people do them internally as well. That's fine. But yeah, but Adam, you mentioned to me before, so in the Tribute, some single family housing developments, I think you mentioned those are doing pretty good.
Yeah, they have been. I mean, our multifamily that we have in our portfolio, we don't have a whole lot, but the multifamily's been doing good from a collection and vacancy. And then the Tribute community, if you're familiar, it's up in the Colony. There's two, great golf courses up there that's surrounded by, I think we have the rights to do 2,000 single family lots. I think we have about 1,200 homes on the ground currently. And all the other land, the other 800 homes are currently being developed in some form or fashion. And we just closed during this pandemic our last land from a development perspective. So we're servicing that now. And the builders we have our contracts with our builders to take the lots down. And on our previous land development, the builders are taking down lots ahead of schedule because there's just such a high demand and I think we've mentioned it, the suburban markets are different than the urban markets, and there's a high demand for it. I mean, we're thankful to be in a great area, not too far from Toyota and everything that's going on up there at Legacy North or Legacy West. And so that's a big driver too. And, for us, the Tribute, there's not a lot of communities in Dallas. It's right on a lake with, really high level golf, great trail systems. And so it's a great asset. You get a lot of these people moving from, the Californias, the New Yorks, the Chicagos, the Illinois. They're looking for, more to do outside, and it's a great community. And we've seen that. I mean, we saw, I think in the residential single family, you'll hear people reference a V curve, and we did witness that. It fell off, right at the beginning of March, April, but then right now, I mean, it's right back up. And so it was a V, I wouldn't say recovery yet, but it was a V recovery in the single family lots where we were. And so, yeah, that's been a great story for us.
Yeah, I'm curious if that's going to be a trend. We've talked so much about master plan communities, and there's Uptown and Bishop Arts and tons of great things happening even in South Lamar. But do you think there could be a trend back the other way, or is this sort of short term that far north Dallas and single family and suburban markets continue to show a lot of promise right now?
That's a tough one. I mean, I think the suburban markets in Dallas have generally been going pretty strong, over the last 5 to 7 years. And it's largely because of these great campuses like Legacy West and all these companies moving down into the suburbs. But I still think with the millennials and the kids graduating, they still want to be around the hub of the city. And I think you'll still have the demand and the drive in the urban core. But I mean, you're going to get challenged for the companies like Legacy West, Chase up there. You have a lot of great institutions that are hiring young talent, and they want to be close to where they live and work. And so they will be. But I think Dallas has kind of been experiencing that for the last, 5 to 7 years a little bit.
I might be calling you for one of those lots, Adam, come December 15th. So
hey, let us know, Mike. We can get a nice lake. We can get a nice lake lot for you.
Warm weather, great golf. You might have a buyer right here.
Yeah. Oh, Mike, you'll appreciate this. So one of our courses called the Old American, I can't remember which golf magazine put it out, but got rated the second toughest course. And it was Avid Golfer, second toughest course in the United States behind Bethpage. No, it wasn't. I can't even remember who was number one right now. So yeah, Mike, when you come down sometime, we'll have to go out there.
You may have to talk to my wife and try to convince her to move, but I'm ready to go.
All right, perfect.
Not sure the toughest course is really what I want to play, but I'll make so I think it's interesting, Mike's comment there. I'll just, we talked about location earlier. Maybe it's a little off subject, but anyway, it prompted this thought. We have behind me, right there it is. We just delivered a 28-story high-rise residential, for-sale residential building in the Arts District here in Dallas. And these are very high-end units. We would say that they're the highest-end high-rise condo units in Dallas. But anecdotally, it's interesting. Mike mentioned from Illinois, but we are seeing more than, we have pretty good traffic. We have very good interest in traffic on these condominium units, but it really is interesting. And it's not just one or two anecdotals. It's a fair number of people from California, very well-to-do, successful businessmen and, others, individuals who are relocating to Texas, right? No surprise here, but just to hear it and read about it, and then to see it anecdotally about the traffic and the individuals that come through here, as well as Illinois and New York. So, in all three of those states, sort of specifically, we're seeing a real interest and real kind of trend towards those types of individuals looking to relocate, to Texas, I guess, and to Dallas specifically.
Yeah. Okay. There's going to be a little bit of something for everyone here in Dallas. So come on, Mike, bring it.
You have to promise me a job. I need to keep working. So
Hey,
as long as I can work with you and your team, I'm in.
You're in.
Everybody's gonna work remote. There's no worries. At least that's what I read. I don't know.
Yeah, sure. Yeah.
As an office.
We have Todd Carpenter, leader of our national practice leader, on the call earlier. Is Todd still on? We can just go ahead and get it approved right now. I don't see him. He may have rolled off. But that's hilarious. Brad Nicklin, are you on the call still? Let's see, Brad. Oh, hey, Todd. How's it going? So can you approve Mike coming to Dallas? And, I don't know if he's there or not. I saw him. Anyways, anybody has any other questions? I think this has been pretty fantastic. Please raise your hand or ask it. We are muted, they say. Connexus, can we get a little help to make sure people can get unmuted?
Yeah, we're working on that. We can ask people to.
There I go.
There we go.
There's Brad.
I fixed it. Paul, I'm here. I've been listening.
Okay,
Paul,
great.
hey, Paul, we've been here.
I will give you feedback. If you could yell real loud when you're going to do a polling question instead of sneak attacking. We are trying to, accomplish a couple things here. I feel like it's a stealth effort.
Okay.
Hey, Paul, this is Todd, and you unmuted us. And if Mike wants to move, he can, and his wife probably wants him to. I know you're going to have to get permission from her.
Nice.
That's a fair point.
So Paul, I will add a little anecdotal information. I mean, we work with one of the largest PE firms in the nation, and we have not seen any kind of slowdown in their throughput, either from a sales or from a buy perspective. They're still transacting. They're still getting bank deals done. They're getting deals done, and they're moving forward. Now, they are not chasing a lot of commercial work, but commercial office buildings and things like that, but they haven't really been focused on that at all. So, they're chasing industrial, manufactured housing, student housing, multifamily. They're still very active in the market. So things are happening. So it's great for us. And, I think it's just great for the entire economy as a whole. So we need that.
That's optimistic. That's great to hear.
Brad nailed the industries right on the head. I mean, I've talked to several, both private lenders, banks, and then also capital raisers. And there's no capital out there right now for a hotel construction. I mean, we might get some coming in the near term, but it's hard to get that financed. And so really what is getting financed right now are your industrials, your multifamily, student housing, things that have really weathered the storm very well. But you try to go get a loan for a hotel or a retail strip, it's going to be hard to come by, and you're going to pay for it.
Yeah, they're definitely circling.
Yep.
But a couple of hotels, though, Adam, in their portfolio, actually down in the Keys, interestingly, they are really busy because a lot of people are going and getting away, and they've actually recovered from where they were way behind being shut down. They're way ahead just because they can command rate and they're busy.
Yeah,
so that's promising.
Yes, it is.
So Todd, any last words for us? Any observations? Are you still there?
Yeah, I'm still here. Can you hear me, Paul?
Yeah, I can hear you.
No, I think next what you guys said, hit it right on the head. It depends on the asset class. We've seen some hotels starting to recover. We actually have a client with a huge grand opening in Austin this weekend at the Kalahari, which interesting that they're a huge indoor water park that's opening there, and I think it's pre-sold a lot. But the multifamily area, the refinancing, the banking industry, what we're seeing in the financial markets has kept it fairly positive. But obviously there's just bad asset classes of retail and others that have other challenges, right?
Well, sounds good. I really appreciate everyone's
So
time today.
Paul,
Yes, sir.
I'm afraid we need about 7 more minutes of commentary to properly qualify.
Oh, to get all the CPE in?
Yes, do we have any other questions from the gallery or any other comments that we can stretch a little bit on?
Sure, I'm sure we can do that.
We could tell interesting stories. Those little known facts that you guys were asking for, right?
Yeah, what are some of
Tell
those?
some great real estate stories and we'll be good.
Yeah, we were talking about Minot, North Dakota. And one of my first jobs was to go there and audit the Minot dispatch or whatever it was. And I go to the rental car counter to get the keys, and they hand me the keys, and then they hand me an extension cord. I'm like, what is that for? And she goes, that's for you to plug in your car and that your block doesn't freeze. So sure enough, there were plenty of outlets to go plug in your car when you were parking to go do the auditing. It was in the middle of January. It was cold. I didn't decide to relocate into Minot, and I really didn't go back. So there you go. One interesting story that you guys don't really care about, but you needed a couple minutes.
Yeah, there you go. Who owns an electric car?
I do.
Okay. Do they work in really cold weather?
Well, I haven't had it through the winter yet, so we're going to find out. But I know that it's bad. But on the Minot, that's not even that's standard operating procedure up there. I grew up on the border of Canada and Minnesota, and we had plugins hanging out of all of our cars all year round. We plugged them in every night.
Right.
I don't think they still do, but we did back then.
Yeah. Exactly.
And we wonder why everyone's moving to Texas and Florida.
Yeah, for sure. So, Brad, what are some of your clients? Are they how are they dealing with this in the real estate world? Are most of your
I mean, I
fair
honestly,
value
I've been
reporting or historical gap?
mostly historical gap, but we shut down on March 16th as a firm. And fortunately for us and the way the real estate world is kind of structured, it's really lent its hand to being able to do this remotely. So you have a owner in Washington, D.C., you have a JV in Tennessee, you have the property that might be in Tennessee or it could be in Texas, and you have a PM that's who knows where. And so no one is really anywhere, one central location. So we've been doing, hundreds of audits for real estate companies all across the U.S. remote. We just happen to be doing it from the office. So March 17th, we shut down, and now we're all working from our kitchens, and we're able to keep it going. And remarkably, the clients were able to keep it going as well. And that is a testament to, I'd say, being ahead of the curve of being as virtual as you can, being as electronic and in a soft copy as you can, living in the cloud, using the Yardies and those other higher end, software programs to be able to do your accounting and your financial reporting. And we did not skip a beat, and nor did they. And I was more worried about them because I knew we were already doing it. So it was pretty remarkable. And the amount of digital transformation, Paul, that I've seen this summer has been off the charts. And so, you can hear it on CNBC, but Microsoft says that they did more digital transformation projects in 2 months than they did in 2 years prior. So digital transformation is the Power BI, the Tableaus of the world, where they're coming in and helping companies visualize their business and their data. Instead of being all over the place with spreadsheets, now they have a dashboard. And our teams on the DT digital side have been super busy. So helping clients really kind of imagine the possible to be able to really kind of see and visualize and manage their business differently. So it's been great.
Your team's built some really interesting products in that regard. You want to give a quick?
Yep, we
update
did.
of promotion
So we have
on
a very large REIT that needed to kind of run different what if scenarios to decide whether they wanted to sell something at different price points, and also to be able to, in a very automated way, test their REIT compliance. And again, on a dashboard. And so they can look at the concentrations of where their bets have been made all on a map. They can look at what asset classes they're in very quickly. They can then look at the what ifs. If they sold this, what happens to the testing? If they sell this, what happens to the testing? And as we all know, REITs, if you blow your REIT status, that's a big no-no in the real estate tax world. I'm not a tax guy, but not a good answer. And so, we're just trying to help them be more efficient in how they approach, running their business and their fund. It's a fund, large fund.
Yeah, I suppose it could have helped them also evaluate their assets in this environment to make changes in their portfolio as well.
The one other thing we did do is use technology to help them holistically understand where they were with cash across their entire platform. So we were able to automate pulling the cash from each of the deals across a couple hundred deals to be able to help them manage cash and understand that where the properties were and where the fund was from a cash perspective. So that was another kind of secondary project that's fallen out of this situation.
I do have a question from some of the participants. Maybe Don or Adam, are you guys, the question is regarding office lease terms. Have they decreased post-COVID? Are y'all signing shorter leases?
It's look, the whole discussion about office is a fascinating one. Part of the discussion I'm hearing about, I think there was almost a euphoria about, hey, we're working at home, and actually the companies are still, functioning, right? I mean, we had never tested this before, and so there was this sort of, wow, this is really, really fabulous. And then there was sort of this feeling of, hey, we're all at home, which saves commute times and all kinds of other things. So I'm going to get to your answer, but I'm just fascinated by this conversation. I'm just fascinated in thinking about sort of the cultural changes and the impact to the office business and to our business specifically. I think ultimately, we end up with some sort of hybrid model where, there is more work at home, but that office, continues to be a vital function of every company. I just can't conceive of companies operating in a vacuum, in a void of, sort of virtual world. Some, but very limited. I just think that, companies will need to, they're sort of living organisms. They need to create a culture and a sense of place and a sense of feeling together. So that's a preamble to your answer. The answer is yes. At this point, we understand we don't have the answers, right? We don't really directionally, everybody here has a different opinion or has some, iteration of a different opinion on how the future of office looks. There's really not a consensus. There's just a lot of different opinions. And so we recognize that, and we recognize decision makers don't want to make decisions relative to their office needs if they don't have to. And certainly, we can accommodate that. The real tension point is, tenant improvements. And to the extent not much in the way of tenant improvements are needed, you can be very flexible on term. To the extent there are tenant improvements that are needed, that's where the tension is, because you have to be able to amortize those over, some period of lease term. So, I would say that's where it's sort of kind of rubber meets road.
Are you seeing any changes yet in floor plans and what tenants are looking for, or too early to tell at this point?
I think it's too early to tell, but I do think, that feels like a consensus view, at least, or a consensus trend, out there that, we will, there has been, for us, it's interesting, and I won't go on too long on it, but from the office standpoint, there's this been, this densification trend over, the last 5, 6, 7 years, which is fine. Putting more people in less space, you think, okay, well, what is that? What does the landlord care? And the only reason the landlord cares is you can't park them. You have to build parking for them, and parking is the least profitable part of any development. You want to build the least amount of parking you possibly can. And the extent there's densification, it creates tension on your economics to the extent you have to build more parking. So I think one thing we will see is less density, which will actually, work in a good manner in several different directions, and primarily the need to construct less parking.
Yeah,
Awesome.
I agree with your virtual or your hybrid model for sure. And I agree everything what Brad said as well. But the one thing that's hard in like our business is coaching, teaching, culture. We have
Right.
so many people that start with us every year, and not being able to sit with them and coach them and mentor them. You just can't do it the same way virtually. You try as hard as you can, but you can't. The client work, we can knock it out of the park from anywhere, but that interaction with our team members, that's what's lacking. They're looking for that guidance. It's just tough to do virtually. It really is. So
Yeah, and I think that will be. I think right now the trend is more people think, oh, I like working at home. I'll continue to work at home. I think that trend will ebb. It's not going back to the way it was. I'm not suggesting that, but I think that trend will really ebb over time.
But as quickly as we had to pivot to what we would never have envisioned over the last 100 years, right? How do you think we will just stay there today, right here, just like we are? We're going to switch back. When we get the green light, and that's to everybody's point about it's going to be a fast recovery. We just don't know exactly when, but my gosh, this week, 90% efficacy. We are well on our way in 1 year. It is unbelievable. And it's remarkable. And science has won. We will get through this. We're resilient. It's going to be a little bit of time, but man, once we get this out, the green light's going to happen and we're all going to be back in that car, stuck in traffic. Going to Astros games and going to Nats games.
I applaud that feeling.
I'm telling you, it's true, man. It's going to happen. We all have bad memories.
Great.
Yeah,
So,
that's a good thing. Yeah. Well, good. No, well, good. Maybe we should end it on a positive note like that.
Yeah, we definitely should.
We've made our time requirements. The discussion has been rich. I really appreciate everyone jumping in. So everyone, thank you for joining us. Thank you for taking the time out of your day. We hope this has been helpful. And give thanks to FEI Dallas and all our sponsors. We really appreciate it, everyone. Have a great evening, a great rest of your week.
Our next event will be February 18th. So thank you to everybody and take care. Be safe.
yep. Do the same. Take care.
Good night now.
Thanks all.
Thanks.
Thank you.